Good afternoon, everyone. My name is Scott Lurie. I am the founder of the Hard Money Co. We are embarking on a free, meaning you will never be sold anything during this presentation. There's nothing to sell you. A free webinar series, which I'm super excited about. Our team has been focused on sharing a lot of great information with many of our borrowers, potential borrowers, clients, people that are flipping houses, people that are using other forms of capital. This is a great resource, and I'm super excited to be here with you today. Part of the format today is that you'll see that there's a live running chat. I've got our senior loan officer in the room with us, Danny Thompson. Danny will be filtering out your questions, feeling them out, sharing them with me, and we will be answering them. So as we're going through the presentation, if you have any questions, ask it. There is no such thing as a dumb question, a silly question, a question that is too remedial for anybody. If you don't know the answer to a question, please ask it. We will answer it. We will always answer it. And if we don't have time to get to it, we will get right back to it. We talked a little bit about the free webinar series. That's what this is. I started flipping real estate in 2003, having zero knowledge of anything in real estate, except I knew one thing, that everybody I looked at around the room and any of the rooms I was in that had wealth had some connection to real estate. And I knew in 2003, as a young aspiring entrepreneur, I wanted to be in that room. But I didn't have any way to learn. I didn't have any webinars. There was no series like this out there. So today is truly an opportunity to give back a little bit to the investor community. For those of you that have taken the self-starting mission of joining us today, we're grateful that you're here. This is could be a first step, it could be a last step, it could be just additional education. But once again, thank you for being here. By a show of hands or just comments in the room, how many people are currently investing in real estate? Maybe just type a yes or a no. If you're engaged in real estate, just type maybe a yes or a no. Love to just see a little interaction from the audience of who's in. Peter, can I get the full screen up here? That's great. Thanks for interacting. We're going to do a couple other interactions that goes along. Please participate. We'd love to have you involved. One also thing I'd like to mention, if you're looking to follow us on the internet, I am available at Hard Money Scott on Instagram. Feel free to share that with your friends. This content will be also brought forward to you there. Peter? Okay. We're having just a little loading issue. So let's see if we go. Let's try it one more time. Okay. Well, so today's webinar that we're going to be discussing, as Peter's fixing the technical difficulties, as we go through the presentation, we're focused on the most important part of the deal, which is property valuation. Everybody always asks, how do I find a good deal? Where is a good deal? What is a good deal? And it all really comes down to the core basics of property valuation. What is the property I am contemplating investing in, buying, flipping, burst strategy, doing? What is that currently worth? What can it be worth? And how do I make a buy off of that? And so as you go through property valuation, we have also with us today, Brett Jump, who's the Hard Money Co.'s property valuation specialist, who's going to jump on and be able to give us some help. I'm going to pause for 1 minute just to make sure that we can fix the presentation. So we'll take a question while we're waiting for Peter to get this situated. One of the questions that came in is, what do we lend on? What is our business? Our strategy is, our business is really focused on 1 to 4 family. We call that a single family, SFR, 1 to 4 family, duplex, triplex, 4 families. That's our bread and butter. We can approve those loans. If they're in an urban market, we can approve those loans and get them closing as soon as 10 days. So the goal behind what we can do is 1 to 4 family. If you're buying it for buy and hold, buying it for buy and flip, or buying it as a rental, all of that strategy is important to what we do in our underwriting, and we'll show you that in a minute. We're going to give you a full behind-the-scenes tour here. The ground up, the modular, that all has a lot of distraction to it. Ground up is incredibly complicated. I am a developer myself. I am building right now $200 million of real estate. I can tell you that every single day we have problems. If you don't have the capital and the knowledge behind it, those deals sometimes get to a stalemate where we have to either come in and finish the project or resolve the issue. And as a result of that, we really focus on lending on just the core, which is the 1 to 4 family fix and flip loans. I can tell you that there is ample money to be made in that business, the 1 to 4 family fix and flip. Thank you. So we're talking about some of the topics. I hope that answers your question. Some of the topics for future webinars. If you have anything you want us to ever cover in a future webinar, please let me know. Today we're talking about valuation insights. We're also going to talk about alternative financing, negotiation tactics. That's one of my specialties. How do you go in and make the offer when you know that the person wants $200,000 and you offer them $60,000? How do you do that? What's the art to that? I'm going to show you that art in a future webinar. We also discuss share of sales. We finance share of sales. If you're going to go buy at the share of sale, you need to come to the closing. You need to come to the sale with 10% of the cash and then the 90 additional percent in 10 days. We finance that for you. Financial modeling, we're going to talk about deep into these spreadsheets that I get lost in my head. And what's cap rate? What is DSCR? What are coverage ratios? What is the banks looking for? How do we raise the equity? We're going to talk about all of that. Rehab strategies, scope of work, market analysis, risk management, and most importantly, some of that is portfolio growth. How do you scale and grow your portfolio? So if there are other topics you want to discuss, put them in the chat. I promise you I'll take a hard look at them, make sure I can get enough content together to give you some more insight. Today I back up to 2003. I started with zero. I didn't have any real estate. I had no assets. I had $0. But all I had was one goal, and it was 100% hustle. I wanted to become wealthy. I wanted to create cash flow, and I wanted to do it through real estate. How many of you want to do that in real estate? I'm sure all of you that are here are interested in real estate and want to create a self-sustaining cash flow business in real estate. You should. You should be typing yes. You should be saying, yes, I want to learn, do more. I'm not selling you anything. I got nothing to sell you. But you should sell yourself that this is something you want to be committed to. We fund deals. Just a little bit about our company, the Hard Money Co. We're a hard money lender. We close about 500 loans a year. We close loans in the greater Midwest region. We fund deals. We fund deals, repairs, dreams, flips, rentals. We fund everything in the 1 to 4 family fix and flip market. If you have something that's outside of that, I got an 8 family, I got a 10 family. Well, let's look at it. Let's talk about it. But our core, if you come to us, our team can respond within 24 hours to give you pre-approval, term sheet, offerings on a 1 to 4 family in 24 hours. My goal, transparency, urgency, diligence, and hustle. You got to come to the table with hustle and 100% commitment to finishing your project. The path to wealth. I grew up, a little bit about myself. I grew up in the middle class here in the northern suburbs of Bayside, Wisconsin. I went to Nicolay High School for any of those of you who are familiar with the area. I grew up and I knew that the most amazing part about real estate is I started with OPM, other people's money. OPM comes in all walks of life today, right? It comes in the shape of grandma, comes in the shape of mom, dad, father, brother, sister, hard money lender, private lender, IRA lender. We're a hard money lender. We can talk more about who we are, but we'll do that at another time. Today, we're just talking about how we were able to create growth. For me, I knew OPM was the way. I was able to build a $300 million rental portfolio with, you guessed it, $0 of my own dollars. I didn't use any of my own money. None, $0. I was able to go and syndicate and raise money from everywhere else in the world except my own money. And then I replaced it with debt, and I was able to keep 50% of the deal. The challenge was, I gave away 50% of the deal, and I wish I would have just used another lender that would have let me keep 100% of the deal. So I gave away a lot of money, but I'm very proud of where I am today, and I'm excited about our future. But what I realized after flipping hundreds of homes and buying thousands of apartments, I realized that there had to be a better solution, and that's when I founded the Hard Money Co. So a little business tips that we're going to throw out here: feedback mindset. Take rejection and criticism and use it to be a better investor. You always can learn. I learn every single day. I learn from our deals, our projects, our trials, our tribulations, our successes. Every day I'm taking feedback, our team's taking feedback, and we're getting better. There's never a time that we can't get better. So, does everyone understand and know what the ARV is? It's the most important part of our business model, is determining what we describe as the after repaired value. So when we look at what the after repaired value is, people say, how can you buy a home that's worth $200,000 for $50,000? I say, well, I don't know how you can, but I know how I can. And it's the art of the entire process of buying a distressed asset, improving the asset to get to what we describe as some future date of an after repaired value. How do you get to determine the valuation of the ARV? So everyone understands we're going to use the term ARV, and that always means after repaired value. So the goals of property valuation. This is so important because most of the time, and we're going to take some good questions with Brett in a minute, but we're going to talk to Brett, and Brett's going to say, your ARV was 380,000 and my ARV is 250. Now, the nice part is the deal probably still works, but how are you ever going to get to 380 when the real ARV is 250? And so we have to set realistic expectations. You want to set realistic expectations for success to accurately assess the project. You're not a cowboy, you're not pioneering, and you're not creating a gold laden house that will be worth more. It doesn't help the value. So we're going to just set reasonable expectations. That's the most important part of what we're doing. We're going to create a financing baseline, determine the financing needs using an accurate ARV, have a plan, understand the scope of work, which we're going to talk about, which is very important, purchase price, repairs, and then any additional expenditures, which includes contingencies, very important. Every project that we develop, we have some factor of a contingency, 3, 4, 7, 8% contingency. It's so important because we, every single time, use all of our contingency. It's amazing how it works out. Property validation, right? This is one of those that I think is pretty important, right? Confirm the project's profitability. If it is not profitable to you, you can't force it to become. It doesn't have that opportunity. If the ARV is what it is, then you have to look at your scope of work and determine, is this a viable project for me? Yes or no. I can tell you that to get to this valuation right here, this validation, you might have to look at 100 deals. And if you look at 100 deals, what's going to happen is you're going to get this one right here. You're going to get the winner that you're going to make $50,000 on. And I always say, how hard are you willing to work for the $50,000? Here's what happens. From 100 to 1, 99.9% of the investors disappear. They go away. They get what you call fatigue. They don't think it works. I don't have the right recipe. I'm never going to find a deal that gets into my category of working out. That's incorrect. When we used to go make offers from 2003 to 2009, I used to write 100 offers a month, and I was hoping to get 3 deals a month. 3 deals a month times 12 gets to 36 deals a year. How many of you want to do 36 deals a year? All of us do. So you have to make 1,200 offers, which means you have to find 1,200 opportunities to get to 36 deals a year. Think about that. Do you have the tenacity? Do you have the drive? Do you have the perseverance to get kicked in the teeth 99 times? Because on your 100th offer, you might make a deal and you might make $75,000. So for that month, how hard were you willing to work to make $75,000? I will work very hard to make that $75,000. And then obviously risk mitigation. This is so important. What are your downside risks? What are your concerns about anything? How do you mitigate risk? How do you reduce your risk proposal, your risk options? Want to reduce them? Have we checked the roof? We're not cowboys. Have we looked at the foundation? Because if somebody hasn't looked at the foundation, if someone hasn't looked at the roof, and somebody makes a $50,000 offer higher than you, I promise you they will not be as successful or successful at all. Risk mitigation is very important. So let's talk about goals of property valuation. We talked about it, but here it is. Accuracy. This is the one thing that Brett will talk a little bit about. Make sure that you're realistic with the ARV. No, a 4-bedroom house with 4-bedroom, 2-bath that has a beautiful, brand new kitchen. Yes, it's worth more on the ARV than what a 4-bedroom, 2-bath to the neighboring house is without it, but it's not worth $300 million more. Be realistic of the value. Consistency, market understanding. When you find your market, if you're investing in Milwaukee, if you're investing in South Carolina, if you're investing in North Carolina, Chicago, Illinois, Detroit, Michigan, it doesn't matter. Know your market. Know the boundaries. Boundaries, right, north, south, east, west. Know your boundaries. Understand your market. And then don't be a cowboy. Be a conservative investor. Don't be skittish. Don't be too far down the conservative path, but don't create opportunity where you're going to come in with your ARV at 450 and our ARV is 250. The $200,000 disconnect we see daily. I look at every file that comes through here. I can see our ARV is 240 and your ARV is 380. That doesn't happen. That's not possible. So understanding the neighborhoods is also most important when you're looking at the market. If you look at a marketed deal, There are boundaries. You can't go cross the boundaries and say that this house is worth X more. It's not. And so don't create that. Don't create that sense of urgency in your mind. Creates the sense of it's a buying opportunity. And that's the biggest important thing for you. So budgeting based on ARV. An accurate ARV is crucial. We talk about this all the time, but it's so crucial because it establishes the baseline of where you are. If the house is worth $100,000, right? My penmanship's great. $100,000. If that's the ARV, you can't buy that house for more than, let's use a simple basics, 65% of that. You got to make a profit. You got to make it an opportunity. But what happens when you get into the repairs? What happens when you get into the budget planning? What happens when you get into the financing of it? So we have a 70% rule here to the guidelines that you should not purchase less than after repairs, 70% of that value. So if the house has $100,000 value and it needs $20,000 in work, now we're at $80,000. 70% rule says your buy number is $56,000 on that property. It's not 57. It's not 58. It's not 54. And you can get to that number. Now, I always tell people in the buying art, which we'll talk about in another webinar, you can always start here and go up so long as you have a salesmanship in your game. This is the art right here. I'm going to start at 40,000. Well, 40,000 is too low. How about 45? Oh, okay, I'll take 45. But you can never start at 60 and he or she says, yes, I'll take 60. And you say, I'm just kidding, 45. Doesn't work. Our economics don't work that way. So you cannot go this way. You can only go this way. Any questions on the 70% rule? Any question on anything we've gone through, please put it in the chat. We will jump into those questions. I'm sorry about my penmanship. I used to write cursive, and then they gave me a computer, and now I barely can read my writing, but it kind of looks all right. The breakdown. So let's go through the numbers, right? This is super important. Take your time going through these numbers. If you start with an accurate number versus a bleak number versus a much bleaker number. If we agree that the ARV is $300,000, if we set the ARV at $300,000, here you go, 210. That's 70%. You got a purchase price of 180 because you have repairs that go into it. The loan amount will be 174. Your cash to close are $49,000. Your profit number in this scenario is $33,500. Okay? If you're off by 10%, if you say the ARV is 330 and we say it's 300, you're going to do all of this and you might make $10,450. What happens if you're 15% off? What happens if you came in and said, my ARV is 345 and we said it's 300 and you went and put it on the market and you eventually sold it for 300? All of your effort, all of your energy, all of your time has gone into losing $1,100. But you got on social media and you said you got your first deal. You got on social media and you just flipped houses. Who gives anything about that? Yes, ma'am.
Can we go back? Question is relating to the percentage rule. It's
finance up to 65% of the ARV. That's why I use it. The number in here of the 70% rule, which is right here, is basically you should not exceed 70% of the total ARV when you get to that number ever. But it's a guideline, right? You can be at 71, you can be at 68. I always start at 50 because I can't go up, right? You always start at a lower number. But this is basically where you draw the line in the sand. You can have a conversation with somebody where you can see your opportunity. I am?
Take a picture.
Presentation's going to come out to you guys. Thanks for being here. Peter will email it to everybody. You all get the content. All you have to do is nothing because it's free. There's nothing to be bought at the end of it. So yes. So here's the opportunity to 70%. I will tell you, my business practice is I start way below 70%. I'm never at 70%. I'm over here. Here's the accurate number. I'm like here. I'm minus money. I'm minus ARV. I think it's worth 250. If you did 250, right, and then you made your offer, your number is now $80,000 profit. I like to swing for the fences. For those of you who don't know, one of my friends here, Jerry Norton, he'll tell you that part of the way to make $1 million a year in real estate is you got to take your biggest wholesale deal and you got to rehab it yourself to swing for the fences. And that's the opportunity where you go in and you say, I'm going to buy a house so deep, I'm going to make all my money. Because guess what? Time is not infinite. You don't have unlimited time. And so I always say, I don't have unlimited time. If I can't buy that house for 250, for 250 ARV, I don't care. And I move on to the next one because I know I'll get another deal tomorrow. Anyone know what a PFS is? Personal financial statement. Here it is. I send this to my lenders every month, every week, every year. Build your personal financial statement. Figure out what your equity is, whether it's phantom equity or your cash balance. It should include cash, real estate, any other securities, anything you want. If you need a form for a PFS, ask me. I'll send it to you. Creating a PFS is the gateway to start. In 2003, my PFS had 0. I didn't own a home. I rented an apartment. I leased a car. I probably had negative liability at that point. Creating a PFS, it shows every one of your apartments, every one of your dwelling units, every one of your homes. Create a personal financial statement. You know what you do? You look at it every year and you say, how can I get better? I call mine Project Crush It. That's my PFS. That's my code name for it. Create your Project Crush It. Add 1 unit a year, 5 units a year, 10 units a year. Create a personal financial statement. Gives you a clear vision exactly where you want to go. You spend all your time wanting to go there, write it down. So we're almost there, Brett. Finding comparables. The process involves finding properties that are 1-to-1, right? They're not one. So 1-to-1 in terms of what we say is 4-bedroom, 2-bath Cape equals a 4-bedroom, 2-bath Cape. Okay? That's 1-to-1. We can understand that, right? That's really simple. Now, the next question on the 1-to-1 is the distance, the proximity. So we're going to start with 1/10 of a mile away, and we can go all the way out to a mile away. As you get farther away, the 1-to-1 becomes less than 1-to-1 or more than 1-to-1. And so you need to be very mindful of what you're doing when you're looking at comparables. This is where we see the biggest disparity in expectation of ARV and reality of ARV. So we verify properties to ensure they match exactly what you're doing. You can get all of this information from many resources online. We're going to talk about them. But when you go and look at the resources, you can run filters. Don't get distracted. If you want to only see Cape Cods because you're comparing the Cape Cod, don't add ranches into it. They're not the same. They have a whole different sales value. So be mindful of that. Be focused on the market. Be consistent with the comparables. We maintain consistency across all markets. Don't be a cowboy or a cowgirl. Stay really focused on exactly understanding and being consistent with exactly what you're trying to get done. It's really important. This is where all of the sauce either is made or ruined before anyone ever gets started. Online tools, all right? So we have a lot of online tools available for us. I'm sure everybody either has access to regional MLS or has someone that can give them access to regional MLS, not by giving you passwords and usernames, but giving you the data that you need out of MLS. There are so many free tools available to help valuation skills. What I would tell you as an exercise for you is go and create a comparable report every single day for the next 30 days. Pick an address, that one. Drive by the house, pull that address. It doesn't matter anything about the address. Go run comparables on that house. Find a house that's sold next to it and figure out what it's worth. There's online data sources. This is so important. We're going to talk about it. There's PropStream. There's a new one that's out. It's an amazing new one. It's free. We're actually going to be running a promotion to pay for the paid part, which just gives you 2,500 skip traces a month. It's called propwire.com. Our link will be sent out with it. It's an affiliate link, but we're going to be paying for it. We want you to be able to have this free data. Sorry. So we'll send it out to you. You can join. It costs you nothing. Nothing to buy. There's nothing here to buy. All we're giving you is the data that you need. PropWire. It's founded by Jerry Norton, and it's doing amazing things. And then you obviously have Richer Values, which is a more extensive. We pay for that. It's expensive. We're going to take a look at one of those. And then we obviously have the consumer platforms. Who's been on Zillow, Redfin, Realtor.com? We all have been there. All of these are just data sources. You can check from all of these sites together, because guess where all of these are getting their data from? The MLSs, public records. They all come from the same data sources. PropWire. So check out my friend Jerry. There he is. Check out his platform, which is propwire.com. It's free. I will send you our link after this. You can join under our name. It does nothing except tells Jerry that you came from us. That's it. We will be paying for a part of your subscription, which allows you to pull 2,500 leads and skip trace those on a monthly basis. I'll tell you more about that at a later date. So the process, I'm going to run through this a little quickly because we're going to then dive into an actual transaction so we can actually show you how we do this. So you have locations and boundaries. How many people believe that if you go right or left off of a main thoroughfare, the value on the right side is worth different than the value on the left side? Me, it is, I promise you. Unit style and type. This is also important. A single family compares differently to a duplex versus a triplex, a condo, a ranch, a colonial. All of them compare differently. Don't make up your own math. Core metrics. Yes, it matters if the house was built in 2024 or 1902. That matters. Number of bedrooms, bathrooms, square footage. We break down to the common denominator, which everyone uses as square footage. That's a great breakdown. But you'll also see that there's other factors that go into that. Lot size also does matter. Basements and garages, consider whether they're finished or unfinished, attached or detached. If they're considered living space or not, very important. That means if, like, for example, if you finish a basement and add an egress window, you can put that as additional living space, which creates additional value, which we've seen a lot of investors, a lot of investors have done so over the last several years. Sale date. Well, this house sold in 2000 and it doesn't matter. There is enough comparable data out there today that you should be able to use under 1 year, or more specifically, under 6 months of sales data. And what I'll also tell you is we don't use pending data. We don't use any other data except solds to get to a value, which is very important. If you are in an area where you're investing, where you have fewer transactions, don't invest there. I'm just kidding. But be mindful that if you're investing in a rural area, there's less friction, there's less opportunity for comparables, there's more opportunity for risk, there's more opportunity for exposure. Property condition. Yes, look at those pictures. How many realtors or how many people have met a realtor that says, I'd like to get professional pictures done for the home I'm going to sell? Me. And when they post them, all I say is, thank you, that house looks beautiful. And as I compare it to this house that's over there, it's way different. It might be a 4-bedroom, 2-bath colonial, but this one has a finished basement, an updated kitchen, updated bathrooms, new garage that was just built. All of that's important to determining the value. And then finalize a realistic price by aligning to the above factors. Get to all of this data right here, 1 through 6 gives you this, equals 7. That's how you determine where you're going to put the ARV. Location and boundaries. We talk about this other side. The other side of the tracks is an expression for a reason, the other side of the tracks. How many people have heard that expression before? Me. How many people have lived it before? I have. When I used to invest, I live in Milwaukee. When you invest in North Avenue, if you went to the south, you're in Brewers Hill. If you went to the north, you're not in Brewers Hill. And those two houses have probably a $200,000 plus difference in ARV. So if you have a home that's all the way to the south and one that's all the way to the north, and they're only 0.2 of a mile away or a half a mile away from each other, they are not the same home. This one might be $550 and that one might be $250. But you can get caught if you think that this one's worth $500 when it's really only worth $250. Defining radius, the most critical factors, right? Comps are located. Why only comparables within the same city and town? Yeah, stay within the closer you can get to the radius, the better off you are. Start at 0.1 miles away. Urban comps are within 0.5. And so when I say urban, you can start at 0.1 and you can go to 0.5. You don't have to start at 0.5, but you can look at what's out there, or you can start at 0.5 and then narrow down. All the data is on there. It tells you exactly distance. And then underneath it, it tells you 0.2, 0.5. You know how far away it is. And then a tangible boundary. Create that boundary. If you're looking at an area and here's Milwaukee, the houses that are east are very different than the houses that are west of 43. Different value. When you get to 43rd Street, Sherman Boulevard, somewhere over here, houses this way get to be a different value again. I know that because this is my market. Do you know your market? Yes. Unit style and type. Comparable properties must have the same unit mix and type. So we're going to talk a little bit about this as well, but compare a single family home to a single family home. Compare a duplex to a duplex, a condo to a condo. It's super important. There are different values and different opportunities that go along with every one of those types of homes, and you should compare just those. If, for example, you struggle on a 3-family, right? I got a 3-family, but I only have duplex comps. You can then break that down to a unit count or a unit value. That's a demising value you can create, right? I've got 2 units, and now I really have 3, and what's the 3rd unit worth? Is it the same size? Is it in the attic? Is it a different type of setup? Is it in the Polish flat? There's so many different values here. So you've got to not create more than you think you need to create. And it's also crucial to compare similar style builds. So we talked about this, ranches, colonials, Cape Cods. Stick with what you know. In all urban markets, there's ample friction to be able to satisfy your needs. So let's talk about the metrics. How do we determine metrics? We're talking about year built, beds and bath, and square footage. Those are cores. That's just so simple. This house has 5-bedroom, 3-bath, and you're comparing it to a 2-bedroom, 1-bath. Doesn't work. Square footage. This 4-bedroom, 2-bath is 989 square feet versus this one's 1,300 square feet. Doesn't work. Still refine your search to get to a closer value. These core metrics are simply as basic as it comes. Year built, bed and bath, square footage. That's what you want. They're core. Start with those. Basements and garages. Is there a difference between a basement, a finished and unfinished basement? Yes, there is. If you add an egress window to the basement and give egress out of the basement, there's even a bigger distinction. If there's an attached garage versus a detached garage, there are certain neighborhoods that only have detached garages. There are certain neighborhoods that have various different types, whether you're coming in off of the alley, whether it's attached, detached, there's so much going on. Look at what your core is. I have a home that has a finished basement or an unfinished basement built in 1965. That's a Cape Cod located here. Find the exact same sold items within 0.1 miles to 0.5. You can find it, I promise you. Sale date and property condition. When do these sell? So we talk generally within the last 6 months. If you're working in an urban market, you have so much traction on friction. The amount of transactions that are happening every single day, you could probably start less. But if you want to start wider and bring it down narrower, go ahead. It's not going to harm your search. But when you're looking at a home that sold 2 years ago for X value, who knows? And then a well-maintained and a well-built property inherently holds a higher value. That's true. A well-maintained property, one that aesthetically looks pleasing, has a different value. Look to see, drive the neighborhoods. You know, the best part about working in a neighborhood that you can be part of is you can actually physically drive every single comp. I've got one on 44th Street. I got one on 45th Street. I got one on 44th Street. Drive by all 3 of them. Oh, 44th Street over here looks great. 44th Street over here, my subject property, it has a serious problem. Okay, let's go take care of that. Let's write them an offer. Price determination. So once we see comparable properties identified, the purchase prices are analyzed to an established value. This is so important. Data points, valuation, discipline, discipline, and discipline. Once you've done all of the homework, once you've done everything in those previous slides, you want to create the value that works for you. Here's what I'll tell you. I see this every day. Someone says, I'll counter you and I'll give you my highest and best. And they go from 102 to 115. I'm like, you just gave $13,000 more. So we're working on trying to make 40 grand, 20 grand, and you just threw away 13 grand because you didn't do enough homework. You just said, oh, it's 13 grand, like you're at the casino, right? Why do you think the casino takes your money away and gives you these little chips? Well, you're not doing that in real estate. So it's very important. Don't be a cowboy or cowgirl related to the counters, the highest and best. Stick to your offers, talk to the agents, communicate. You'll get there. Other considerations. What's your strategy? How many people own rental properties and love the BRRRR strategy right here? Yes or no in the chats? We got a few? Okay. So we got a few people. The BRRRR strategy has a different purchase price. Sometimes you might be wanting to get a little bit closer to your highest value on the go because you're trying for a different objective, right? How many people have done the BRRRR strategy and are not looking to over leverage, but just get 100% financing? Me. I know people that are willing to get 150% financing, and that's a whole different strategy as well. But it all starts on the buy strategy. Valuation trusts. Know your numbers. Feel good about what you are doing. And then practice. When I said practice earlier, drive around a neighborhood, pick out a comparable. When you got to the coffee shop or wherever the hell you're going to spend your afternoon, run your comps. Practice it. Practice a buy. It's okay. But if you're going to practice it, you're honing your skills to make that $50,000. How many people want to make $50,000 a month extra? Me. How many basketball players do you know that don't go to the gym early and eat well so that they can become better, be part of the all-star team, get their bonuses and their contracts? All of them do. You should be too. Defining rehab with valuation. Okay, this is another thing we see a lot of issue with. Okay, scope alignment. Don't create a scope that is not reasonable or able to fit into the property you're trying to solve for, and don't over improve. Those three things all at once will probably save you a couple $100,000 a year. Value matching. Make sure that you're finding consistent with the neighborhoods and avoid unnecessary enhancements. Well, what if I put in, why would you do that? What if I did, why would you do that? Homes that are in certain neighborhoods were built by city planners and developers, some are 100 years ago, some are today. They're defined for a reason. Most people in a conventional home don't have a 4-car garage. Why are you adding one? You don't need it. And then most important is ROI, return on investment. Return on investment. Okay? You want to make sure you get an ROI that makes sense with what you're doing. If you're going to create a cowboy return, you're going to be negative $1,100 and you're not going to be happy with your ROI. Don't pioneer the process. Property valuation, determining an ARV. Here we go. We ready? Anyone sleeping? Are there any questions from anybody out in the field today about anything we've covered this far? Okay. So he looks much better in person, but Brett Jump is our property valuation specialist. Brett is here. He's not on camera. Brett does have a mic. He's going to be communicating with us. Brett is our property valuation specialist at the Hard Money Co. And he's also a real estate agent in the Milwaukee market. Brett, you can ask him any questions you want. Brett has done hundreds of valuations a month for us. He also does them for his clients, and he also knows the market incredibly well, and Brett is very good at property valuation. So, Brett, welcome. We're mic'd up, we're ready to go. We're going to run through some property valuations here. We're going to go live on air evaluating a property. We're using a property in Milwaukee only because that's where we are. We're right here in Milwaukee. So we're going to use 3624 North 50th Street. Alignment. Let's talk about it. The Hard Money Co. and the investor were aligned on this property. With ARV completed after application submitted. The scope of work was detailed. So important. Spend time. I always wonder. I'm like, did you just rush to do your homework or do you not want to make the 50 grand? And then managing success. The investor is consistently communication on the project process. Through the scope of work, we talk to our investors every single day. They come by, they tell us what's going on. We're going to pass this because we're running out of time. Okay, I'm sorry. So I'm going to, at this point, we're going to flip screens and we're going to go live onto Brett's computer. And we're going to talk about the valuation at 3624 North 50th Street. So Brett, let's get started.
All right. So this is a property that came to us probably like 2 months ago now from a borrower. The property right now is a 3-bedroom, 1-bathroom Cape Cod with 1,200 square feet. It's got
It's a 3-bedroom,
one
bath.
Yep.
Okay.
1,200 square feet.
1,200, and it's a Cape.
Cape Cod.
Okay.
Yep. And it has 1.5 car garage and an unfinished basement currently.
Garage and unfinished. Okay.
Correct.
Okay. Thank you.
So the borrower decided after running comps on this property to get the most out of its investment that he's going to make it a 4-bedroom, 2-bathroom Cape Cod with a finished basement.
So this is where we were, and he's going to go to a 4-bedroom, 2-bath with a finished basement.
Correct.
Okay, so this borrower is adding a 1-bedroom, 1 full bath to the home, and let's talk about the valuation. So here we are, Brett. Can everyone see the MLS up on the screen in front of them? Okay. Take it away, Brett.
Okay, so now that we've identified the details for the property, how it was, what they're going to make it, and what they're going to need to put into it without over improving the property, we can set up our search and run our comps. So I'm using the Flex MLS here because I'm a licensed real estate agent, but you can also use the same principles across the board if you want to use Zillow, PropWire, PropStream, or anything like that. So
just to, I want to dig in a little bit for a minute here. So you talked about, Brett, you're now using this search, this query that you're going to run right now, which is similar to filters on PropWire or some of the other sites. So let's get into the details.
Yeah,
okay.
So we're going to set all of our parameters, kind of going through everything that Scott outlined earlier in the presentation. We're going to focus on our type first here. It's a single family property. We only want single family comps. We can't compare a single family to a duplex. After we do that, we're going to figure out our borders and see how far we want to go out to find comps. This property is located right here on the corner of Keefe and 51st Streets. Knowing the market here, we know that comps are higher to the west of Sherman and to the south of Capitol here. So I'm going to make my little radius and I'm going to go into this pocket right here, roughly half a mile, as you can see where I drew my box there to kind of go on the major streets on 60th, Burleigh, Capitol, and Sherman.
Okay, so looking at Brett's doing this expansion right now, he's not cowboying, he's not creating anything. He knows that there's a distinction between these main arteries. And so he's dropping this geography, this geographical balloon that's going to narrow in on the search. It's so important because if he went to the north of it, it's a whole different subset of values. So right now, Brett is going to drop that, and we've got our geography, our geographical circumference that we're going to use.
Correct. And after we have that decided, I'm going to go through and select the status of the comps that I want to pull.
Okay, so when you say status, can you tell us what the 3 different statuses? There's other ones, but let's just use the main one: active, pending, sold. Just to help.
Yep, there's active comps that are currently out there on the market that may have accepted offers or not. There's delayed status, which is something that comes on, that's showing that it's going to be coming on the market soon. There's pending, which means it's under contract and set for final sale. And then there's the sold comps. As Scott mentioned, we typically like to just focus on the sold comps, but I also, just to kind of see where the market is trending, I like to keep some of them in there to verify what I'm coming with a value for my sold comps.
Yeah, so what Brett's saying is 100% spot on here. So we're looking at all of the data to give Brett a pulse on the market, right? Brett wants his finger on the market. This might help him for tomorrow's comps. He might be able to see a pending that turns into a sold. But what we're really focusing on, as you can see in this circumference right now, is there's enough results in the circle that we have 64 results of active, delayed, pending, and sold, and we have enough sold that we can get to our value. Okay, so there's enough activity. Look at this amount of activity in this square mile right here, or that I don't even know how far that radius is at this point. half a mile radius. Okay, so at a half a mile radius, we have 64 active, delayed, pending, and sold comps.
Yep.
Okay.
All those comps are within the last year. I went all the way out. I never go more than a year. But I like to get a full data pool of it. But typically you only like to go out to 6 months to get the most up to date.
So Brett can refine that by changing the sold date to equal, and that can be 180 days. Instead of 367, it can say 180. And if you click it to 180, let's just see if we go real time. We say 180, sorry. And if we update that, we have 51. So we lost 14 potentials, but there's still ample solds. So you can even refine even further down to 90 days to even figure out, go to 90 days just for a second. So that took us down to 22. So there's still enough activity in this market that you can see the solds are still happening 90 days out. 90 days ago, you can see that. So let's go back to 180 days or whatever number you want to run this comparable for us at.
65, because we did run this a couple months ago.
So we're going backdated just to get to where we were, but okay, great.
All right, and then the next thing we want to do, we want to make sure that this is going to be in the same municipality and county. The comps are going to be different prices if we ended up being closer to Tosa and accidentally pulled something from there.
Right. So there are borders in your community, and what Brett's saying is if you were to go out towards 60th and North Avenue, you could end up in Wauwatosa if you drew the half-mile radius balloon. So Brett is precluding them from coming into our comparable data set because Tosa is completely different than Milwaukee. So Brett's checking County of Milwaukee to get us only Milwaukee County, which does include Wauwatosa. But then the next check, Brett, go ahead, municipality. Yep. Municipality is a city of Milwaukee, which keeps us in the city of Milwaukee. Great.
And then the next thing that I'm going to do, I don't always break these down, but we do for this one, I'm doing for bedrooms, bathrooms and garages just to get rid of all unique type properties. So if a property has less than 3 bedrooms, it's unique, it doesn't appeal to as many people. So I'm making sure that my comps are going to have at least 3 bedrooms. If a property only has 1 bathroom, it's a little more unique, there's a less pool of a buyer market for it. And ours is going to have more than that. So we're doing 1.5 bathrooms. And then garages here, we're in Milwaukee, it's cold. We have to drive most of the places we go. People have cars. So they want to have a garage covered from the snow. And that's a big deal. So we're going to make sure all of the comps have a garage as well. Okay,
so we're starting with a pretty wide but detailed search, right? We have a 3-bedroom. We're only going to see homes that have 3 bedrooms plus. We have 1 bath. We're actually going to only see bedrooms that have 1.5 baths because we're going to a 2-bedroom house, 2-bathroom house. So he's excluding any one comparable because he only wants to see anything with 1.5 or more. What's a half bath versus a full bath? The difference is one has a shower or a bath, a shower, this is called a shower and a bathtub, and a half bath just has a toilet and vanity. Okay.
So now that we have all of our parameters set up here, all the comps are going to fit right within those parameters, and we can kind of start to look at the condition and the comparables of them in the last year here.
Okay, so now all of those 64 that Brett has shown are now going to show up right here in the valuation of what we're looking at. So he's now sorted them to come into ascending order, it looks like.
Yep. So we're going to start by looking at the highest solds in the area because ours is going to be the freshest on the market. It's going to be fully renovated. So we want to find the stuff that's selling for the top dollar here.
So we're looking at the ARV. So Brett is going back to saying what homes have sold for the highest values because that's how we're going to get to what the ARV is. Because remember, we're going to have a fully renovated house that's going to have 4-bedroom, 2-bath, a finished basement from what we're starting at is a 3-bedroom, 1.5 bath, unfinished basement. So we're going to have a complete gut remodel of this home. Okay, let's go.
So then I'm going to go to the top comps here and I'm going to start looking for stuff that fits within roughly 25% give or take of our square footage of our house. So I'm going to start at the top, go down and start to pick ones that fit within that parameter.
So remember, our square footage on this house is 1,200 square feet. So Brett's trying to be as close to 1,200 square feet in parameter of what we're looking for.
Yeah. So the first comp I see right here, this is probably one of the most recent ones because it hasn't sold yet. It's contingent. So we typically don't like to use those till that they've sold, but I've looked at this and there's other similar comps that have sold. So I'm going to include that kind of to assume that that's where the market's starting to trend right now. So this one has.
The other thing just to mention on that, Brett, if you go all the way over to this architecture type, it says it's also a Cape Cod. So that's important to realize that you're actually mirroring apples to apples. And the estimated finished above ground square foot is 1,316. This is a pretty good comp for us just based on a couple high-level numbers, but it seems pretty close, and it's a Cape Cod, but it's only active with contingent. It's not sold yet, so carry on.
And Scott hit the nail on the head with that one right there. I'm only looking at stuff that's going to have at least 1.5 stories. I'm not even considering ranches right now. I try to avoid 2 full stories, but I'd rather go to something that has a 2 full story than a ranch if this one's going to be 1.5 stories. So we're looking at Cape Cod style homes. So I'm going through these. Square footage is too high here. Square footage is too high.
When Brett says the square footage is too high, it's being thrown out. We're not considering it. It's not being checked. It's out of the category. The other part of it, it's a bungalow. He's throwing that out too. So we're trying to dial in. We're trying to dial in the refinement, specifically focused on how to get to the closest comparable of the ARV of this property.
So I'm going to go through and check the ones I want, and then after the fact, we can go through and verify condition, and we can make value adjustments to it. So we got that one checked right there. This one, 1,800. That's a little too high for me. So the next closest one that I have here is 15, almost 1,600 square feet, and I'm going to select that one. It fits with all our parameters. It's a little high on the square feet, but we can dive into the condition as we go forward here. So that one's selected. We're going down here, 1,600 again. It's got the 4.2. It's got the Cape Cod style, along with the last one was Cape Cod. I'm going to select that one. And then I have another Cape Cod that's, pretty close. It's 1,300 square feet, 3.2 with the garage there. So those are the best comps I got. When I start to get a pool, I want to get 3 to 6 comps. I got 4 right there. Then I kind of start to look at condition as I go down, and I start to realize where I left off here. We start to look at these.
Go back to that front picture. The first one. No, when you just showed up this house right here. That first picture. My favorite. It's a realtor special. Let's go to it. This one, no, one more over. This is the ultimate realtor special house. Lights are on, a little fading into it. House looks like it's welcoming and it's got a great appeal. Okay, let's carry on.
So I kind of started to see when I was looking through comps for this that there's different brackets. There's maintained, there's like partially updated and fully renovated. And we'll see here that these are starting to drop down to the partially updated condition. So if you're looking at the property, it looks like they got some, newer floors in there. The kitchen is in decent shape, but then you start to get through it a little bit more and you see, oh, the bathroom's not updated. The carpet in the bedrooms aren't updated. It's been lived in. So I kind of start to go through these, and the next one down too is similar to that, like not as updated kitchen.
Which one is the next one you're on?
West Phillip right here. There's the main picture of the property.
I can't see it. Okay, so this is another. Okay.
Yep. So this is another one that I'm starting to see up. So this isn't completely renovated. So I'm starting to get down to the partially renovated stuff. So I know that my top comps are realistic for what we're trying to discover here. So after I have those, I'm going to go to all of my comps, and then I'm going to dig into them a little bit deeper here. So these are the comps that I have right here. You can look at them on a map. They're all kind of separated around here. Ours is right around this area here. So they're relatively close and kind of pooling around. Typically, you kind of want something that fully pools around right here. But we have stuff to the north and south and to the west. I mean, they're all pretty comparable. So
and so the blue ones are the sold. The green one is active, but it's contingent for sale right now. So that means it's pending a sale, but we're all within that half-mile radius, and we all were within the geographical borders that we've talked about that keep us really tight fit to make sure that we are determining a true ARV. Now, just to give everyone a little baseline, at this point, you should have a pretty good idea. You should have a pretty good idea of what this house is worth. I have a pretty good idea what the houses we're going to be worth on the ARV. You should also. You should have a general idea based on where you are, based on the Cape Cod, based on square footage, based on conditions, where this house is going to trade for. How many people think it's going to trade for over $400,000? No one. Good. Okay.
So then we'll go to the list of the comps here. Ours is going to be that 4.2 with the finished basement and 1.5 car garage. We have a 3.2 here at the bottom. That's kind of at the lower end of the price point. So it could be a little bit higher than that because we have an extra bedroom in there. And then we get to the higher stuff up here. It's got an extra bathroom and a bedroom in this one. So we're kind of, what I like to do is take an average of all these comps, typically that fit within, give or take a little bit of the parameters, and then come to an ARV. But we'll just go through and look at these and verify here. You can see all these conditions of these properties are renovated as I expected when we went through it.
That's a pretty nice home. That looks like that house has just been bought and flipped.
And
So this looks like staged. It's a staged home by some stager. House looks like pretty well done. It looks like new flooring, new LVT or LVP, some staging on the walls. I think this is a good looking house. Can we see the front of it? Okay. Cape Cod. Got you.
so again, something that we didn't use in our parameter search was the basements. We really, it's a thing that's really going to drive this to the top comps is having a finished basement with these. And I go through and I verify that all these have finished basements as well. So that one did. Here's another Cape Cod bungalow style home,
right there.
completely renovated.
Yeah, so this looks like another flipper. This looks like another guy who's just swung for the fences. Nice job. Looks like they did a great job. They did a good job staging it. Nice modernized bathroom. Looks like they finished the basement. This is the basement that's finished. So if you look what they did, they put down flooring. They've added some lighting. They didn't finish the ceiling, but they've done some nice things. So this is one of our borrowers that did this house. Okay. Yep.
So then we got 3 comps, and typically we like to get 3 to 6. Here's another one right in that pocket here. Cape Cod, all brick, completely renovated, kitchens, bathrooms, flooring with the finished basement. So that and then again you have with the market's kind of trending over here, that property that's under contract that meets our criteria that just isn't closed yet.
And this one's another flipper.
Yep.
Brand new kitchen, brand new appliances. Place looks great. So Brett, I think you have good comparables at this point. What did we set the ARV of this house for?
So
Hold on. Everyone put in the chat your ARV number. Before Brett discloses it, everyone type in your chat, what did you think the ARV of this house is that we're comping out right now? Do you think it is? Whoever gets it nailed on the head, we're sending out t-shirts. So let us know your ARV number. We'll give everyone a minute.
235, 245, 325, 240.
All right, we got numbers coming in. Take us home. What did we determine?
So with looking at where the market's trending with the contingent property up there, and with ours having a larger bedroom count than some of the lower comps, typically we like to see the markets kind of trend up. I put the ARV at this at 250, which is a little more aggressive than I like to typically go, but I see it's a really strong market. I mean, you're easily going to get the 245, and the numbers worked really well at that price point. I think
250, we put the ARV in. Anyone get 250?
Speranza.
Okay, let's get him. Let's get him a great T-shirt. Thank you for the 250. He might have cheated though. Well, yeah, Santiago might have cheated on that one. That's okay. Santiago, how you doing? Nice to see you. So let's say we got to 250. 250's ARV. What was the purchase price of that home?
$120,000.
So our borrower paid $120,000 for this home. The scope of work was what? $60,180 and sold it for, we don't know yet. But let's say 250, though they should make net of everything about $50,000.
Returning borrower.
So this is a returning borrower who's done many deals with us, who has already been a proven case study, who continues to operate through finding these homes. These homes are available by the hundreds in your cities. I promise you that. If you're looking for deals, we will be discussing them through webinars. Any questions for Brett?
How do you determine the cost of construction before inspection?
So how do you determine the cost of construction before inspection? Well, you don't really do it before inspection. You do it while you're doing your walkthrough of the property, right? That's the trick of the trade. You've got to get very good at understanding linear feet, how much flooring's going to cost. Go spend your time at Home Depot. Go talk to people. Look at what rehabs are. Talk to everybody you can to determine it. It is very hard because some people say it's going to cost you 40. Our borrower came in at 60, and I promise you he's going to be at 60. He might be at 50. That's how you get good at it. If you spend 90, you're eating into your returns. This house can be renovated, 1,200 square feet, can be renovated easily for $60,000. Guys, we're at 1 o'clock. We're going to stick around for a little bit because there's nothing better than talking real estate. If you have to jump off, I promise you, we will send this presentation out to you. Please follow us at Hard Money Scott at Hard Money Scott on Instagram. We are continuing dropping free series. As I promise you, and will continue to promise you, I got nothing to sell to you. This is all for you guys. If you have any other questions or any other topics you want to go through, please share that with us. We will make sure that it's an appointment for us. We got a few extra slides to finish with, and then we'll bring it home. I want to thank Brent Jump. He's an unbelievable property valuation specialist. He's been here for a while. He does an unbelievable job. If you want us to run through any comps or have any questions while you're doing any of your due diligence, please give us a call. As I said, we fund deals, repairs, dreams, flips, and rentals. Would love to learn what you guys are doing in real estate and how we can help you. Talk a little bit about our loan terms, just as a quick plug of our terms. We can close into 7 to 10 days. We fund up to 65% of the ARV. We have a 6-month term, and we charge a 15% interest rate. If you're in our loan for 6 months, you're only paying 7.5% interest. So don't get lost in the weeds. These borrowers are making $50,000 to $80,000 a deal, and they're paying $10,000 to $14,000 of interest. So our business, as we talked about, we high interest rate, short-term loans. We do everything in-house. Brett's our property valuation specialist. Our on-site origination is done in-house, and we look for partnerships with real estate investors that are looking to do multiple deals. If you're looking at take control of your future, real estate has done it for me. I know it can do it for you, and I'd love to help you be part of it. Here's our simple process, just to give you an idea. We go through the application to initial review to underwriting to loan terms offered. All through that process should be 24 hours. We get into processing. We get to game day. Everyone loves a game day. You do your repair draws, and then here is the green. Time to make the money. If you want to discuss any of the process with us or any of our loan originators, we're happy to discuss that with you. Our easy application process, QR code if you're interested. Otherwise, visit thehardmoneycode.com. If you're a real estate investor, we only do non-owner occupied home. You can complete the application in 5 minutes. And we do have a borrower portal. Once you get on our site and you want to do multiple deals with us, the borrower portal makes everything so much easier. It's available for you at thehardmoneycode.com. And yes, ma'am.
Now, what about credit?
So we're an ABL or an asset-based lender. We are a hard money lender. Credit is important to us, but it is not something we review at the initial underwriting. So we look at the asset that you're borrowing money against and your business plan. That's number one for us. We do look at credit. If you're looking to refinance the property, we do want to make sure you have a credit score that can get refinanced. We don't want to write you a loan if you can't complete the project. So I'll give you one word of advice about credit, though. Credit is a true indicative resource in our world on how you will perform. Please be mindful of your credit. Pay your bills. Don't overspend. Don't neglect those vendors or creditors that you owe money to on a personal level. Pay them. It impacts you. There is a huge difference in your future if you have a 680 credit score versus a 750 credit score. The 750 credit score person will make way more money than you will ever make. And it's just because they'll get better rates, they'll get better terms, and they'll get better financing at the end of the game. So please be mindful of the credit. We do not require a credit score, but we do want to work with people that are mindful and respectful of the process. If you've joined here today, we are offering you a $200 closing cost credit. It is free. If you close on a loan with us and you want a $200,000, let us know you're at the webinar, you will get a $200 closing cost credit. If you have any friends that are interested in what we're doing here, free webinars, please send them it. Please have them follow us on Instagram. We'd love to have people join us. This is free. We're building content for you, the real estate investor. When I was in 2003, I only prayed I had someone like these content that I could even go off to say, how did I figure out the value? How would I even determine what the ARV is? We didn't have any of this information. I was out there cowboying it myself. Any questions? Any questions I have not answered? All right. Well, if we don't have any other questions, I want to thank everybody for joining us. If you are a current borrower of ours or have done deals with us in the past and had a great experience, my last request and only request is if you could leave us a great review on Google. We would love to have a Google review from you to say how we've been able to help you and how our process has been. If we've earned your 5-star service, great. If we have not, please call me. I want to speak to you about the process that you've received because I feel as though we deliver 5-star service to everybody, and I want to make sure we gave it to you. So there is thehardmoneycode.com. Google, there's a review page. It's free. If we've done good to you, a review is all we're asking for. Thank you all. We do have a question. How much time do I have? The question is, can you explain the syndication system that I have done to build my rental portfolio? And the answer is this. Yes, of course I can. I don't have enough time today. I will do, whoever asked that question, because everybody probably says, how do I scale from one duplex on 37th in Glendale? I bought it, 4577 North 37th Street was my first rental I ever bought. And I took that and I built that to 2,000 apartments with none of my own money. We will do a webinar just on that. That is fun. We might need an hour and a half, but we're going to do that. So thank you for the suggestion. Please follow along. We will get that webinar up for you. So the question is, what happens if you're buying a property that's fully occupied today and you can't move them out until the leases expire? That's a challenge. So there's two ways to do that. If I was in your shoes, I would buy deeper. I would say, listen, you either need to cover my cost of financing for 6 months to absorb that cost, or that's one option. Or two, you got to do cash for keys for some of the tenants and say, listen, why don't you go find a different place to live and maybe have the sellers share that with you. So there is many different means. There's a solution to every problem. The number one would be, hey, seller, I need a $10,000 closing cost credit so that I can pay for my financing charges that are going to go past 6 months, etc. Try it. I guarantee you they say, okay, that's fine, and they'll work with you. Sometimes they say no, and then you have to get creative. But that scenario is a tough one, specifically because tenancy, not all tenants are civilized. Not all tenants choose to be mindful of the relationship. And while you have a contract in place, sometimes you can ask them to get out and see what they say. So tough scenario. Certainly one that there's an opportunity for. Make sure you're buying deep enough. Buy deep. Buy deep. You can't buy deep enough. I promise you, you can't make enough money. That's all the questions for now, guys. Thank you so much for being here with us today. I hope you found the content to be useful. I can't thank my team enough, Peter, Brett, Danny, for being in the room, helping us facilitate this webinar. We will be coming live to you with another webinar series. I'm not sure if we're going to do the syndication one next. We've got a whole series that we're bringing forth to you. As I said, these are free webinars. Please share them with your friends, share the content with them. This will all be coming out to you. I will tell you, please be mindful. Please be mindful that it's a journey in real estate. There's not a get-rich-quick scheme here, and you should be prepared for an unbelievably fun and fulfilling journey if you stick your nose down and grind at the pavement to get to the finish line. So from the Hard Money Co. and for myself, Scott Lurie here, I just want to say thank you, and I appreciate your time. We're signing off, and we'll be back in touch with you guys shortly.